Good morning and welcome to TOI Japan Market Radio. This is Monday, February 2nd, 2026. I'm coming to you from Tokyo with our daily briefing for global investors tracking Japanese markets. Let me bring in our portfolio manager who focuses on Japan macro to walk us through what happened overnight and what we're watching today.
Thanks for having me. So we saw a fairly weak session across Japanese equities today. The Nikkei 225 closed at 52,655.18, down 1.252%, while the TOPIX ended at 3713.0, falling 0.828%. The Mothers Index was essentially flat, down just 0.136% at 2,206.0, and J. Wrights actually managed a small gain, up 0.223% to 2019.0. On the currency side, dollar-yen moved higher to 154.78, up 1.1% on the day. Commodities were notably weak, with gold in yen terms dropping 12.702% to 16,495.0 and crude oil falling 4.892% to 62.02.
That's quite a move in gold, and the yen weakness is notable given what we've been seeing in broader risk sentiment. Let's dig into the drivers behind today's session. The big headline coming out of Washington is the Trump administration's announcement of a $12 billion strategic minerals stockpile initiative. This is explicitly aimed at reducing U.S. dependence on Chinese supply chains for critical minerals and rare earth elements. Walk us through why this matters for Japan specifically.
This is a significant development for Japan on multiple fronts. First, you have to remember that Japan sits in a very difficult position when it comes to critical minerals. The country is heavily reliant on Chinese imports for rare earths, lithium, and other materials that are absolutely essential for semiconductors, batteries, electronics, and defense applications. At the same time, Japan is one of the closest U.S. allies in the region and deeply integrated into American technology and defense partnerships. So this $12 billion stockpile signals an intensification of U.S.-China competition over resources that Japanese manufacturers cannot do without.
So you're essentially describing Japan being caught in the middle of this strategic rivalry. What does that mean for Japanese corporates in practical terms?
In practical terms, Japanese companies are likely going to face pressure to diversify their mineral sourcing away from China, which means significant capital reallocation. You're talking about new partnerships, potentially higher input costs, and supply chain restructuring across sectors like automotive, semiconductors, and renewable energy. In the near term, that's a headwind for margins and earnings, particularly for the big exporters that drive the Nikkei and TOPIX. Longer term, there could be opportunities for Japanese firms involved in alternative sourcing, battery technology, and defense, but that's a multi-year story.
And how are you thinking about the market impact across equities, currency, and rates?
For equities, I think you're looking at near-term headwinds for the major manufacturing exporters due to those cost pressures I mentioned. But selectively, companies positioned in alternative mineral sourcing or defense-related sectors could see support. On the yen, the direct impact is limited, but any broadening of U.S.-China tensions tends to support safe haven demand for the Japanese currency. For JGB yields, the immediate impact is minimal, but if geopolitical risk premium rises, you could see modest support for JGB demand as investors rotate into safe assets.
Staying with the theme of risk sentiment, we're also seeing a broader deterioration in global market sentiment with equities under pressure and the dollar strengthening. Bloomberg's Markets Wrap noted that stocks look weaker as sentiment ebbs. How does that intersect with what we're seeing in Japan today?
This is where it gets a bit more complex. Typically, a stronger dollar creates a headwind for Japanese exporters because it makes their products less competitive and reduces the yen value of overseas earnings. But at the same time, when global risk sentiment weakens and equities sell off, you often get safe haven flows into the yen, which can create cross-currents. Today we actually saw dollar-yen move up to 154.78, so the dollar strength dominated. But if risk-off sentiment intensifies further, we could see that flip with yen demand offsetting dollar strength.
So it's a tug of war between dollar strength and safe haven flows. What about the implications for Japanese equities and yields in this environment?
For equities, the outlook is clearly negative, especially for cyclicals and exporters that are sensitive to global growth momentum. When risk sentiment deteriorates, investors rotate away from growth and cyclical exposure, and Japan has a lot of that in the index. Domestic defensives might outperform in this environment, but overall the pressure is to the downside. On the JGB side, you'd expect yields to decline as investors move into safe assets. Lower equity valuations and reduced growth expectations typically compress yields on Japanese government bonds, and we could see that dynamic play out if the risk-off tone persists.
And that actually ties into what we saw in today's session. Shifting back to equities, Tokyo stocks ended lower today, and the specific driver was weakness in technology shares. Given how important the tech sector is to the Japanese equity market, how significant is this?
It's very significant. The technology and semiconductor-related names, companies like Sony, Nintendo, Advantest, Tokyo Electron, represent a substantial portion of both the Nikkei 225 and TOPIX. These are the stocks that drive the earnings growth narrative for Japanese equities, and they're also major exporters, so they're sensitive to global demand cycles. When tech underperforms, it's often signaling concern about either global growth or specific issues in the chip market, and that affects Japan's broader export outlook.
So this isn't just a one-day blip, this could be indicating something more structural about demand or the semiconductor cycle.
Exactly. You need to monitor whether this tech weakness is sector-specific, maybe related to chip supply dynamics or inventory corrections, or whether it's signaling broader economic deceleration. If it's the latter, that has much wider implications for Japanese equities. Tech sector rotation or outright selling could extend the declines we saw today if the narrative around global growth continues to weaken.
And what about the currency and rates implications from tech sector weakness specifically?
On the yen, equity market weakness alone typically supports safe haven flows into the Japanese currency, but that really depends on broader risk sentiment and global rate differentials, so it's mixed to neutral in isolation. For JGB yields, equity weakness and any flight to safety dynamic would put downward pressure on the 10-year yield as investors move into Japanese government bonds. We've seen this pattern many times. When Japanese equities sell off, domestic institutional investors and global macro funds rotate into JGBs, compressing yields.
So pulling this all together, we have US-China strategic competition over critical minerals, a weaker global risk sentiment backdrop with dollar strength, and specific tech sector weakness in Tokyo. For a global investor with Japan exposure, what are the key themes to watch from here?
I think the key themes are threefold. First, watch how Japanese corporates respond to the shifting geopolitical landscape around critical minerals and supply chains. That's going to affect capital allocation and margins. Second, monitor the interplay between dollar strength and safe haven yen demand, because that will determine the currency backdrop for exporters. And third, pay close attention to whether this tech sector weakness is isolated or the start of a broader deceleration, because tech drives so much of the Japanese equity story. If all three of these themes turn more negative simultaneously, you're looking at a more challenging environment for Japanese risk assets.
That's a very clear framework. Just to recap for our listeners, today we saw the Nikkei down 1.252%, the TOPIX down 0.828%, dollar yen up to 154.78, and notable weakness in commodities. The drivers were US-China strategic competition, global risk-off sentiment, and tech sector underperformance in Tokyo. For global investors, the focus should be on supply chain realignment, currency crosscurrents, and the health of the technology sector.
That's right. And I'd just add that in this environment, it's important to differentiate between near-term volatility and longer-term structural shifts. Some of these themes, particularly around critical minerals and supply chains, are multi-year stories that will reshape the Japanese corporate landscape.
Appreciate the insights as always. If you're a global investor following Japanese markets, please consider subscribing to TOI Japan Market Radio for daily updates. We'll be back tomorrow with another briefing. Thanks for listening.